Welcome everyone to the weekend update. So I wanted to get this out here today on Friday as I'll be traveling for the next couple of days. And while the equity curve here is certainly good and still intact, I do have a caveat that you can find more details on, those of you that are subscribers to the service, and that is this big upward tail right here, this profit that is showing right here. Now this lower profit right here, this little section right there, that is legitimate, real trade that we put on and closed out for, I think it was about an 8% profit, something like that. This other one here, which was about $1,000 profit, I got very lucky, and this was not the way the trade was planned to play out. So I had an order out, and again, those of you that are subscribers, go look in the trade circle. I did a detailed video on this and exactly what happened in this case and why it happened the way it happened. And at the end of the day, I was lucky. This could have just as easily gone against me. The trade, if it had closed out as planned, and the basic summary was this: it was a calendar. Calendars, when you're close to expiration, bid-ask spreads get really wide, prices bouncing all over everywhere. So I had one short SPX option that was expiring at the end of the day today. I'm about 20 minutes before the close of the market, and then I have a long SPX at the same strike, so it's a calendar, not a diagonal. I have a long SPX that is expiring on Monday, and I want to close out the entire trade. I need to close out both sides of this thing, and I have an order out there to do so at about a 50-cent debit, or I think maybe I was trying 25-cent debit, whatever it was. And had the trade closed at that price, it would have been between a $50 and $100 loser. But I wasn't getting filled, so sometimes when that happens, I go and I will sell one side or cover one side. In this case, I was going to buy back my short for Friday, and then I do a separate trade then to sell the long strike on the other side. So sometimes if you've got very wide bid-ask spreads, that's a legitimate way of doing things. And if the market isn't moving real fast, not usually a big issue. So that's what I was trying to do. So in this particular case, I went ahead, I covered my short strike, the Friday expiration. I got that closed. I went to sell the long strike at that point. This is a long put. And I went to sell it, and my order was rejected. And here I am panicking. I'm a couple minutes, well, about 10 minutes before the close at this point, and I need to get this off my plate. You never want to be one-sided in a big index like SPX. At least I don't. So I needed to try to get something done with this. So after trying a couple times and the order being rejected, I called the trade desk, and what happens sometimes, particularly if you're trading big indexes, is they calculate margin in a certain way. And they calculate it based on the fact that all of the different positions you have are usually balanced off by something else. So when this was a calendar and there was a 4,500 short strike and a 4,500 long strike a couple days later, well, that nets out to where it's not big risk. I mean, worst case scenario in that trade was a loss of $250. So in that particular case, no problem, not a big risk. As soon as I took one side of that trade off, now all of a sudden it dramatically increased my margin requirements, just like that. And then it essentially stops you from being able to make additional trades. You get an error message. So what you have to do, I use the term force the trade. Well, that's the verbiage they use on the trade desk. So I called the trade desk. I told the guy, listen, I'm trying to sell this long put, and it's not letting me, and you need to recalculate the margin and force this trade. So that's what he did. He reached out to the margin department and just confirmed that there's no problem. And if you don't have a portfolio margin account, which I don't believe in them, I don't like them. from my perspective, it allows you to take on too much risk. And I don't personally want to be able to be in a position to do that. So if you have a regular account, an IRA, a Reg T account, whatever, they calculate margin a little bit differently, more conservatively. And in this case, they basically determined that I shouldn't be trading. I didn't have enough money to make this trade, which is silly because I'm selling something. But that's the way the margin department works, is they just look at the fact that, oh my gosh, all of a sudden this account has way more risk than it should have. Lock it down. Don't let them trade anything. So I called the trade desk, explained, listen guys, I need to be able to get this thing sold now. And so they call the margin department clears it for trading. I can enter the order, I get my fill. Now, keep in mind, during this time, I don't know if the market's moving against me or in my favor, but the market had moved considerably back down. It had it had rallied up going into the close, and in the last 10 minutes, it had sold off a bit, which again, I have a long put, which means that I was actually able to get more money for that trade. Had I done it in reverse, had I sold the long put first, and then I'm trying to close my short, this would have been this amount ugly in the other direction. So at the end of the day, I am showing this here. I am recording this here because it was my actual fills. Had it been the other way, had this been a loss, I would be showing it here because it was my actual fills. From my perspective, as somebody that's trying to provide education, mistakes happen, things like this happen. That's how we learn from them. Sometimes they're going to go for us, sometimes they're going to go against us. And I don't want to be in the position of trying to record what it should have closed at. Because as soon as I start doing that, it gets very, very subjective. I mean, right now, somebody can go back and they can look at every single fill I got, and it's going to match up here perfectly. As soon as I start saying, oh, yeah, I got a good fill here, or I didn't get such a good fill here, I need to boost the level of fill I got there, I don't want to be in that position. So the best I can do is to point out that this particular bounce right there, that $1,000, theoretically doesn't belong there. The way the actual trade closed, if you had gotten a fill where I had proposed the fill, we'd still be in a little uptick, but we would not be making a new high right now. So just want to be really, really clear on that and on this equity curve. Now let's take a look at the positions we have. All right, so we have our Google wheel. We're still up nicely in it, even though the market has sold off as much as it has. This is still up a little bit of money. Again, the goal here, someday, maybe not this particular option, maybe it'll be at some point in the future, I'm actually letting this pull back, and at some point Google will get put to me. And again, I'm okay with that. I'm starting my wheel strategy where I'm going to take the long stock when that happens. So that one's just kind of doing its thing. This particular trade, we had to roll back. This was a tent that had been up here. Again, our market sold off significantly. And as people know that have taken the deep dive butterfly class, one of the standard moves, if you're earlier in a trade, and we're about 7 or about 8 days in on this one, and volatility had increased, which also helped the situation here, is that made sense then to take off the butterfly that was higher. That was a flat fly, by the way, that was higher. And then roll the whole trade back, and I turned it into a broken wing butterfly here. So that's this trade. This was a new trade that I just put on yesterday. This is an Apple, started as a put credit spread. Then when Apple didn't move in our favor, I was expecting Apple to start moving back up. When Apple started moving down against us, I sold a call spread against my put spread. And we actually had 3 put spreads on here, and there was much more risk to the downside. And as the market started selling off more yesterday, I actually took one of those off, essentially raising this right wing up here, reducing our downside risk. Now, obviously, the hope here is that this is just going to kind of chop back and forth and decay in this area for another few days until we get up to maybe 13, 14%, somewhere in there profitability-wise. So that's kind of where we're at. We've got on 2 broken wing butterflies. We've got on our Google wheel, and we've got on this Apple Condor. Now, I will look to get another trade open probably early next week. One of the things that is happening right now, if we look at our market, we've had a fairly sizable sell-off here, but we've largely come through it because the size was kept small. I kept my size very, very small, anticipating that volatility will get higher. Volatility was fairly low. That volatility will start picking up and get higher. And you do not want a heavy load of butterfly type trades on when that happens. So I've kept the trading small by design. We have pulled back now to what I personally feel is a decent support zone from the 4380 down here to about the 4300 range. And we did come down well into that zone today, and we rallied back off of it. Now, we did break into above where we closed yesterday, but we actually closed at about the same price we closed yesterday. So that's not quite as bullish as I might like to see. In the ideal world, this bar, this last green bar, would have been up maybe into the middle of this previous bar. Let me enlarge this a little bit. So in the ideal world, I would have liked to have seen us rally up, maybe here to 43.90 or so, and then maybe closed up in there. That would have been a much stronger technical indication to me. Doesn't necessarily mean we're going down from here, but I do think that maybe chopping sideways in this 4,300, 4350, 4380 range is probably the likely range that we're going to see in the coming week or so. So that is my expectation from a technical standpoint. And again, I never want to speak with any assurances on anything because the market does what the market does. But I try to put odds on these things. And I would say for the next week, I'm thinking about a 60% chance that we're going to be playing in that range, maybe a little bit higher. So that's why the positions that we have are kind of set up to play in that general range. If the market opens up in this range next Monday and I add a new trade, I'm going to be adding it with that general range in mind. Again, unless the market tells me something differently comes Monday. So that is the weekend wrap up for here Friday, August 18th, or the weekend of the 18th. And I guess that's it for now. I did want to just point out that caveat on the equity curve and that one trade. But again, don't really know how else to deal with that. So that's it. We'll talk to you later.